Question 1. An investment advisor representative, IAR, is determining a suitable investment strategy for a new client. The client is 30 years old, earns a high income, and states they are comfortable with significant risk in pursuit of aggressive growth. Which of the following asset allocations would generally be considered most suitable for this client? A. 70% bonds, 20% equities, 10% cash. B. 50% equities, 40% bonds, 10% real estate. C. 80% equities, 15% alternative investments, 5% cash. D. 40% equities, 30% bonds, 30% money market funds. Answer: C. 80% equities, 15% alternative investments, 5% cash. For a young client with a high income and an aggressive risk tolerance, an allocation heavily weighted towards equities and alternative investments is generally most suitable for pursuing aggressive growth. Equities offer higher growth potential but also higher risk, which aligns with the client's stated comfort level. A small cash position provides liquidity, while a significant bond allocation, as in options A, B, and D, would typically be more appropriate for conservative investors seeking income and capital preservation. Always align the investment strategy with the client's risk tolerance, time horizon, and financial goals. Question 2. Under the Uniform Securities Act, which of the following is not considered a security? A. A variable annuity. B. A limited partnership interest. C. A fixed annuity. D. A certificate of interest in a profit-sharing agreement. Answer: C. A fixed annuity. A fixed annuity is not considered a security under the Uniform Securities Act because its value does not fluctuate based on the performance of an underlying investment portfolio. It offers a guaranteed interest rate and fixed payments, making it more akin to an insurance product than an investment. Conversely, variable annuities, limited partnership interests, and certificates of interest and profit-sharing agreements all carry investment risk and are therefore classified as securities, requiring registration. Remember that if a product involves investment risk and the potential for gain or loss based on market performance, it's generally a security. Question 3. An investment advisor has discretionary authority over a client's account. This means the advisor can make decisions regarding A. The type of security and the amount, but not the price or time of execution. B. The type of security, the amount, the price, and the time of execution without specific client authorization for each trade. C. The price and time of execution only, after receiving specific client instructions for the type and amount of security. D. All aspects of trading, including changing the client's investment objectives without prior consent. Answer: B. The type of security, the amount, the price, and the time of execution without specific client authorization for each trade. Discretionary authority grants an investment advisor the power to make investment decisions on behalf of a client without needing to obtain prior approval for each specific trade. This includes deciding what to buy or sell, type of security, how much to buy or sell, amount, and when and at what price to execute the trade, time and price. It does not permit the advisor to change the client's stated investment objectives without explicit consent. Think of it as the client giving the advisor the go-ahead to manage the portfolio within agreed-upon guidelines. Question 4. What is the primary purpose of the Investment Advisors Act of 1940? A. To regulate the issuance and distribution of securities to the public. B. To establish rules for the conduct of broker-dealers and their registered representatives. C. To regulate investment advisors and provide for their registration with the SEC. D. To govern the marketing and sale of mutual funds to individual investors. Answer: C. To regulate investment advisors and provide for their registration with the SEC. The Investment Advisors Act of 1940 was enacted specifically to regulate individuals and firms that provide investment advice for compensation, requiring them to register with either the SEC, for federal covered advisors, or state securities authorities. Its primary goal is to protect investors from fraudulent and unethical practices by investment advisors by ensuring they act in a fiduciary capacity. Unlike other acts that focus on securities offerings or broker-dealer conduct, this act targets those who are compensated for giving investment advice. Knowing the purpose of each major piece of legislation is key for the Series 65. Question 5. A client's portfolio consists of 60% equities and 40% fixed income investments. If the equity market experiences a significant downturn, causing the equity portion to drop to 50% of the portfolio's total value, the advisor would most likely implement which strategy to return to the original allocation? A. Rebalancing. B. Dollar cost averaging. C. Strategic asset allocation. D. Tactical asset allocation. Answer: A. Rebalancing. Rebalancing is the process of adjusting a portfolio's asset allocation back to its original target weights after market movements have caused it to drift. In this scenario, the advisor would sell some fixed income investments and buy more equities to restore the 60/40 ratio. This disciplined approach helps maintain the desired risk-return profile over time, preventing the portfolio from becoming overexposed to a particular asset class. Rebalancing is a key practice for maintaining long-term investment strategies. Question 6. A publicly traded company decides to issue new shares to raise capital. This offering would be considered A. Primary offering. B. Secondary offering. C. Rights offering. D. Tender offer. Answer: A. Primary offering. A primary offering occurs when a company issues new shares of stock and sells them directly to investors to raise capital. The proceeds from the sale go directly to the issuing company. In contrast, a secondary offering involves existing shares being sold by current shareholders, not the company itself, and the proceeds go to those selling shareholders. Think of primary as the first time these specific shares are offered by the company to the public. Question 7. An investment advisor who receives a lump sum payment from a client at the beginning of the year for advisory services to be rendered throughout the year has custody of client funds if the prepayment exceeds a certain threshold. Under the NSAA model rule, what is the threshold for federal covered advisors that would trigger custody requirements? A. $500 or more, 6 months or more in advance. B. $1,200 or more, 6 months or more in advance. C. $2,000 or more, 6 months or more in advance. D. Any amount, as long as it is for future services. Answer: B. $1,200 or more, 6 months or more in advance. Under the NSAA model rules, a federal covered investment advisor is deemed to have custody if they accept prepaid advisory fees of $1,200 or more, 6 months or more in advance of rendering services. This threshold is important because custody imposes additional regulatory burdens, such as quarterly account statements to clients and annual surprise audits by an independent public accountant. The rule aims to protect clients by ensuring greater oversight when an advisor holds or controls their assets. Remember, state-registered advisors have a lower threshold of $500 for similar prepaid fees. Question 8. The gross domestic product, GDP, of a country primarily measures: A. The total value of all exports and imports. B. The total income earned by all citizens. C. The total value of all finished goods and services produced within a country's borders in a specific time period. D. The level of government spending and taxation. Answer: C. The total value of all finished goods and services produced within a country's borders in a specific time period. Gross domestic product, GDP, is the broadest measure of a country's economic activity, representing the total monetary value of all final goods and services produced within its geographical boundaries over a defined period, typically a quarter or a year. It's a key indicator of economic health and growth, reflecting output and productivity. Think of GDP as the report card for a country's economy, showing how much it has produced. Question 9. An investment advisor must disclose all material facts regarding conflicts of interest to clients. Which of the following scenarios represents a conflict of interest that must be disclosed? A. The advisor charges a flat annual fee for all services. B. The advisor recommends a mutual fund for which they receive a 12b(1) fee. C. The advisor owns shares of stock in a company that is not recommended to any clients. D. The advisor accepts soft dollar arrangements from a broker-dealer for execution services. Answer: B. The advisor recommends a mutual fund for which they receive a 12b(1) fee. A 12b(1) fee is an annual fee paid out of a mutual fund's assets to cover distribution and marketing expenses, and it may be paid to the advisor. If an advisor recommends a mutual fund from which they receive such a fee, it creates a conflict of interest because the advisor has a financial incentive to recommend that specific fund over others that may be more suitable but do not offer such compensation. This potential bias must be clearly disclosed to the client. This is a critical example of how an advisor's compensation structure can create conflicts that require transparency. Question 10. Which of the following bond characteristics is inversely related to its yield to maturity, YTM? A. Current yield. B. Coupon rate. C. Price. D. Face value. Answer: C. Price. Bond prices and yields move in opposite directions, they are inversely related. When a bond's market price increases, its yield to maturity, YTM, decreases, assuming the coupon rate and maturity remain constant. Conversely, if a bond's price falls, its YTM rises. This relationship is fundamental because the YTM calculates the total return if the bond is held to maturity, taking into account the purchase price relative to its par value and coupon payments. Always remember that a higher price means a lower effective return for a new buyer, and vice versa. Question 11. An investor is seeking an investment that provides professional management, diversification, and liquidity, with the ability to redeem shares at net asset value, NAV, at the end of the trading day. Which of the following would be most appropriate? A. Exchange Traded Fund, ETF. B. Closed-end fund. C. Mutual fund, open-end fund. D. Unit Investment Trust, UIT. Answer: C. Mutual fund, open-end fund. Mutual funds, also known as open-end funds, are designed to offer professional management, diversification by investing in a basket of securities, and high liquidity. Shares of an open-end fund are bought directly from the fund company and can be redeemed back to the fund at the current day's net asset value, NAV. ETFs and closed-end funds trade on exchanges like stocks, meaning their prices can fluctuate throughout the day and may trade above or below their NAV. For redemption at NAV at day's end, a mutual fund is the precise choice. Question 12. A client has established a revocable living trust. Who typically controls the assets placed into this trust during the grantor's lifetime? A. The beneficiaries of the trust. B. The trustee, who is often the grantor themselves. C. A court-appointed guardian. D. The attorney who drafted the trust document. Answer: B. The trustee, who is often the grantor themselves. In a revocable living trust, the grantor, the person who creates the trust, typically also acts as the initial trustee and retains full control over the assets placed into the trust during their lifetime. This means they can manage, invest, and even revoke or amend the trust at any time. The trust only becomes irrevocable and controlled by a successor trustee upon the grantor's death or incapacitation. This flexibility makes revocable trusts popular for estate planning while maintaining control. Question 13. Which of the following regulatory bodies is responsible for enforcing the Municipal Securities Rulemaking Board, MSRB, rules for broker-dealers? A. The MSRB itself. B. The Securities and Exchange Commission, SEC, and FINRA. C. The Federal Reserve Board. D. The Department of the Treasury. Answer: B. The Securities and Exchange Commission, SEC, and FINRA. While the Municipal Securities Rulemaking Board, MSRB, creates rules for municipal securities transactions and those who engage in them, it does not have enforcement powers. Instead, its rules are enforced by other regulatory bodies. For broker-dealers, the primary enforcers of MSRB rules are the Securities and Exchange Commission, SEC, and FINRA. Understanding which body makes the rules versus which body enforces them is important for regulatory comprehension. Question 14. An investment advisor discusses the potential returns of a specific stock with a client, but fails to mention the significant risks associated with that investment. This action would most likely be considered A. Commingling. B. Churning. C. Omission of material fact. D. Selling away. Answer: C. Omission of material fact. An omission of a material fact occurs when an advisor fails to disclose crucial information that would reasonably influence an investor's decision, such as significant risks associated with an investment. Failing to mention risks while highlighting only potential returns is a serious ethical and regulatory violation because it presents a misleading and incomplete picture to the client. This is a common example of prohibited conduct, emphasizing the advisor's fiduciary duty to provide full and fair disclosure. Question 15. The Capital Asset Pricing Model, CAPM, is used to determine the expected return on an asset based on its A. Diversifiable risk. B. Total risk. C. Systematic risk. D. Unsystematic risk. Answer: C. Systematic risk. The Capital Asset Pricing Model, CAPM, calculates the expected return of an asset based on its systematic risk, often measured by beta. Systematic risk, also known as non-diversifiable risk, is the risk inherent to the entire market or market segment, such as interest rate changes or economic downturns, and cannot be eliminated through diversification. CAPM helps investors understand the relationship between risk and return, focusing on the risk they cannot avoid. Remember, CAPM only compensates for systematic risk, not risk specific to a company or industry. Question 16. Which of the following statements about Treasury bills, T-bills, is true? A. They are long-term, interest-bearing debt instruments. B. They are sold at a discount and mature at face value. C. Their interest is subject to both federal and state income tax. D. They are primarily purchased by individual investors for current income. Answer: B. They are sold at a discount and mature at face value. Treasury bills, T-bills, are short-term debt instruments issued by the U.S. government with maturities typically of 1 year or less. They do not pay periodic interest. Instead, they are sold at a discount from their face value and mature at par, with the difference representing the investor's return. This discount basis is a key characteristic. Their interest is subject to federal income tax but exempt from state and local taxes, making them attractive for certain investors. Question 17. An investor is concerned about inflation eroding the purchasing power of their fixed income investments. Which of the following investments is specifically designed to protect against inflation? A. Treasury bonds, T-bonds. B. Municipal bonds. C. Treasury inflation-protected securities, TIPS. D. Zero-coupon bonds. Answer: C. Treasury inflation-protected securities, TIPS. Treasury inflation-protected securities, TIPS, are U.S. Treasury bonds specifically designed to protect investors from inflation. Their principal value adjusts semi-annually based on changes in the Consumer Price Index, CPI, and the interest payments are then paid on the adjusted principal, providing a real, inflation-adjusted, return. This built-in inflation protection makes them unique among fixed income options for investors concerned about purchasing power. Tips are your go-to for inflation protection in the Treasury market. Question 18. Under the Uniform Securities Act, if an individual performs solely clerical or ministerial duties for an investment advisor, they would generally be excluded from the definition of an A. Investment advisor, IA. B. Investment advisor representative, IAR. C. Broker-dealer, BD. D. Agent of a broker-dealer. Answer: B. Investment advisor representative, IAR. An investment advisor representative, IAR, is defined as an individual who, on behalf of an investment advisor, provides investment advice, manages client accounts, or solicits advisory clients. Individuals performing purely clerical or ministerial functions, without providing advice or managing accounts, are specifically excluded from the definition of an IAR and thus do not need to register. This distinction is important for understanding who is and isn't subject to IAR registration requirements. Question 19. When calculating the net present value, NPV, of a project, the discount rate used is typically the A. Risk-free rate. B. Required rate of return or cost of capital. C. Inflation rate. D. Current market interest rate. Answer: B. Required rate of return or cost of capital. When calculating net present value, NPV, the discount rate used represents the investor's required rate of return or the project's cost of capital. This rate accounts for the time value of money and the risk associated with the project, allowing the present value of future cash flows to be determined. If the NPV is positive when discounted at this rate, the project is generally considered acceptable as it is expected to generate returns above the required threshold. The discount rate is crucial because it directly reflects the opportunity cost and risk of the investment. Question 20. An investment advisor who receives a referral fee from a broker-dealer for directing client trades to that broker-dealer must A. Obtain client consent for each trade executed by that broker-dealer. B. Not engage in such arrangements, as they are always prohibited. C. Disclose the arrangement to the client, even if it does not increase costs for the client. D. Ensure the referral fee is directly passed on to the client. Answer: C. Disclose the arrangement to the client, even if it does not increase costs for the client. Investment advisors have a fiduciary duty to disclose all material conflicts of interest to their clients. Receiving a referral fee from a broker-dealer for directing client trades, soft dollar arrangement, represents a potential conflict of interest because it could incentivize the advisor to prioritize their own compensation over the best execution for the client. Even if the arrangement does not directly increase client costs, the potential for biased decision-making necessitates full disclosure. Transparency is key to maintaining trust and fulfilling fiduciary obligations. Question 21. What is the main characteristic that distinguishes a limited partnership from a general partnership? A. Limited partners have unlimited liability. B. Limited partners can participate actively in management. C. Limited partners have liability limited to their initial investment. D. General partners have no personal liability for partnership debts. Answer: C. Limited partners have liability limited to their initial investment. The defining characteristic of a limited partnership is that limited partners have liability restricted to the amount of capital they have invested in the partnership. They do not participate in the day-to-day management of the business, which is handled by the general partners who bear unlimited liability. This limited liability is a major attraction for passive investors seeking to participate in ventures without exposing all their personal assets. Question 22. Which of the following would not be considered a form of custody by an investment advisor under the NASAA model rule? A. Holding client funds or securities. B. Having full discretionary authority over client accounts. C. Having a client's check made out to the advisor, which the advisor forwards to a third party within 3 business days. D. Receiving client checks made out to a third party, and forwarding them promptly to the third party. Answer: D. Receiving client checks made out to a third party, and forwarding them promptly to the third party. An advisor receiving client checks made out to a third party, such as a custodian or fund company, and forwarding them promptly is generally not considered custody under NASAA model rules, provided the advisor does not deposit the check into their own account or have any control over the funds. Custody implies direct possession or control over client funds or securities, or the ability to withdraw them. Holding client funds, having full discretionary authority, which implies control over assets, or receiving a check made out to the advisor themselves usually triggers custody rules. Question 23. An investor purchases a call option. This investor expects the price of the underlying asset to A. Remain stable. B. Decrease. C. Increase. D. Decrease significantly. Answer: C. Increase. An investor who purchases a call option is bullish, meaning they expect the price of the underlying asset to increase. A call option gives the holder the right, but not the obligation, to buy the underlying asset at a specified strike price on or before a certain expiration date. If the asset's market price rises above the strike price, the call option becomes profitable. Think of buying a call as betting on an upward movement. Question 24. Diversification is a strategy to reduce which type of investment risk? A. Purchasing power risk. B. Interest rate risk. C. Business risk, unsystematic risk. D. Market risk, systematic risk. Answer: C. Business risk, unsystematic risk. Diversification is a fundamental investment strategy that helps reduce unsystematic risk, also known as business risk or specific risk. This type of risk is unique to a particular company or industry and can be mitigated by investing in a variety of assets across different sectors, companies, and asset classes. While diversification cannot eliminate systematic risk, market risk, which affects the entire market, it effectively smooths out the impact of negative events specific to individual holdings. Think of it as not putting all your eggs in one basket. Question 25. Which of the following is not an economic indicator used to forecast economic activity? A. Leading indicator. B. Coincident indicator. C. Lagging indicator. D. Fiscal indicator. Answer: D. Fiscal indicator. Economic indicators are typically classified as leading, coincident, or lagging, based on their timing relative to economic cycles. A leading indicator predicts future economic activity, a coincident indicator moves with the economy, and a lagging indicator confirms past economic trends. Fiscal indicator is not a standard category for classifying economic indicators. Fiscal policy refers to government spending and taxation, which influences the economy, but isn't a type of economic indicator itself. Understanding these classifications helps in economic analysis.